Good morning, all of you.
Good morning, sir.
Good morning. We have started discussing the stock valuation procedures, and I think this valuation procedure is very important because for any investor, that is the critical thing where investments are concerned. They all look at the real valuation, and when you go for the real valuation, you can get a figure for that. After getting a figure, you can see how the stock is sold in the market. Then you can compare. You can compare it with the real valuation, whether it is undervalued or overvalued. So that is one way of getting an idea about the investment. So therefore, in a investor's point of view, that valuation procedures are very important. I think we discussed two valuation procedures where we went through the dividends, because you all know for a stock, dividends cash flows are more important because those are the expected cash flows from that particular investment. Ultimately, if you sell it, you can get the sales proceeds also. That is how the investment, you can think in terms of an investment. When you go for valuations also, we go by the future cash flows. And the valuation is equal to the total of the present value of future cash flows. That is how we structure the valuation. Now, in that case, we go by the expected dividend cash flows in the future. And we assume for each year you get a dividend cash flow, and those dividends being increased by a certain rate. That is called the growth rate. Growth rate. Now that growth rate actually we can, for simplification, we just assume those growth rates are constant. But if you put it into the real life or real situations, you may find constant growth rates very rare. Most of the time, growth rates are varying. But if the growth rate is varying, then our valuation will become more complicated. You should not think that there's no methods to do such valuations. There are, but it is out of our span of course material. Therefore, we are not going to talk on those things, but you need to understand that even though if the growth rate is not constant, we can get into a valuation. There are several complicated methods we can use, but it is out of our scope for the time being. But of course, you need to think that there are several ways of doing it. And the other thing is, now we just went through two perspectives. One is the earnings perspective, one is the dividend receipt or whatever, that perspective, or dividend perspective. The other perspective is the earnings. Now, it is a similar type of an activity where we go by the earnings rather than dividends. But there's a linear relationship with dividends and the earnings, because there's a retention ratio and a payout ratio. I think we discussed about that. Retention ratio is the amount we keep in the business or in the company. Payout is the amount paid out from what you have earned. Paid out in the sense that is a payment to the shareholders. That is what you call the dividends. So then from that you get the relationship. We have discussed about that relationship also. D0 is equal to E0 into 1 minus B. B is the retention. So 1 minus B is the payout. Now when you multiply the payout with the earnings, now here we call, when you say earnings, it is earnings per share. That is what you normally define. Earnings per share. Now I think we did some problems, we did some examples in order to have a good idea about it. But here the real thing here is, there's a very famous indicator in the stock market. We call it the PE ratio. PE ratio. What do you mean by PE ratio? P is the price of the stock. E is the earnings per share. P over E is what you call PE ratio. It is not a percentage. So you normally put it in terms, in times, like P over E. If you say 2, that means price to earnings ratio is 2. That means stock price is twice the earnings per share. So such type of definitions you need to understand. And at the same time, you should be in a position to relate the dividends and the earnings. And I just gave you a certain example and to show that when you go by the growth rate, if you go to the growth rate of dividends, how can you get the growth rate of earnings? At the beginning, I can just ask a question. Right. Anyway, if I say growth rate of dividends is G, if it is a constant growth rate, I say now the dividend growth rate is G. What is the growth rate of earnings? I think you try to give an answer for that. Now I said the growth rate of dividends is G. Now I am asking a question. What is the growth rate of earnings? What is the growth rate of earnings? Yes, Udeshan has given an answer. Yes, very good. Is correct. All others can try and see. I think it's a very simple logic. It's a very simple logic. Why do I say that? Now, when I say you have to just go to the relationship between the dividends and the earnings, because that relationship is a linear relationship. So therefore, if you have a growth rate, that growth rate is equal. Dividends growth rate is equal to the earnings growth rate. You can show that even. You try. Now, what you say is E0 is equal to, sorry, D0 is equal to E0 1 minus B. Now, you can see, now this is a linear relationship. It's a linear relationship. So, since that is a linear relationship, you can say that if dividends grow by certain percentage, earnings also will grow by the same percentage. Okay, I think that's a very good point to note. And you can connect the dividends and earnings with the growth rate also. Right. Now we can go into the lesson again. Right. Now you can see the lesson on the screen. Right. Now in this lesson, I have just given you the earnings approach. Now as we went through the one-stage model and the two-stage model for dividends, earnings also has the same types of two stages, one stage and the two stage. Now here, earnings approach is this. Now you can see the one-stage model being replaced with earnings rather than dividends. Now you know, as per the one-stage model for dividends, one-stage model for we call it one-stage model for the price calculations. P0 equals D1 divided by K minus D. That is the present price. D1 is equal to E1 into 1 minus B. So that is how we have replaced D with E. And you can further expand it to this level because E1 has been replaced by E0 into 1 plus D. Then you get this point. And P0 divided by E0, you can rearrange this into this way. And this 1 minus B is taken as D0 divided by E0. That is another way of putting these things. So that such ways we can have an equation for PE ratio. Now this is the equation for the PE ratio. I think you can appreciate the importance of PE ratio. If you go for stock market information documents like stock market daily or stock market monthly or something like that, you will find all these ratios in that. If you go for a company analysis, and you can click to the market and just go by each and every company. And from that, you will be in a position to find out the betas and all in companies. So for your different types of calculations, the necessary information can be extracted from the stock market publications. In Sri Lankan context, we have to go to the Colombo Stock Exchange website, csc.lk. So you will find all of these information documents in that. So that information documents, you will be in a position to extract the beta values. But I think there's no formal information sheet for that. What you need to do is you need to go for each and every company. And you click that market, this thing, and you can go to each and every company. When you go to the company details, company profiles, you will find the beta of that company stock as a particular date, as on a particular date. So that is how you can get the betas. That is one way of getting the beta, or there's another way. You can do your own calculations and get the beta. You all know how you can calculate the beta, right? So I'm just giving those things also because we have to connect this beta calculations, capital asset pricing model, dividend one-stage dividend discount model or two-stage model for these activities. So therefore, you need to see the relevance and the relationship with all these matters. Now you will see several questions on this lesson units, and I can say that in question papers also you will find a number of questions on this, and if you can thorough with these things, you can really face the examination in a very confident manner. We will just go by this example. I don't think that we have discussed this example. The common stock of the Blue Diamond Corporation is currently selling at $60 per share. Dividends per share have grown from $150 to the current level of $4 over the past 10 years. And this dividend growth is expected to continue in the future. What is the required rate of return for the Blue Diamond Corporation? Now, I can't remember whether I have just described this in the class, so that I will do it now. The common stock of the Blue Diamond Corporation is currently selling at $60 per share. Dividends per share have grown from $150 to the current level of $4 over the past 10 years. And this dividend growth is expected to continue in the future. What is the required rate of return for the Blue Diamond Corporation? Now, how are we going to do that? In order to have the required rate of return calculated, we need to get the dividend growth rate first. So how are we going to get that dividend growth rate? Now you can see the explanation here. Now future dividend is equal to present dividend into 1 plus g to the power, that is to the power comes with the number of years. Now in this case, present dividend into 1 plus g to the power 10 will give the 10th year dividend. Now in this question, 10th year dividend has been given. That is $4 at the 10th year. So first year or the present dividend is 150. So therefore, 150 into 1 plus g to the power 10 will give you the 10th year dividend. 10th year dividend has already been given. So therefore, these two things can be equated. Now, equation has been created by this data. Taking the data into consideration. Now, just look at the left-hand side. That is the 10th year dividend. 10th year dividend. In the question, it says the 10th year dividend is $4. So that is why we put 4 there. And DP is the present dividend or current dividend. Current dividend is 150. And G is the growth rate. 150 into 1 plus G to the power 10 will give you the 10th year dividend. Now you can see when you get the first year dividend, it is equal to D0 into 1 plus G. If you want to get the second year dividend, that is D2 is equal to D0 into 1 plus G to the power 2. So likewise, the formula is given. So in the same manner, you can get the 10th year dividend, D10 is equal to D0 into 1 plus D to the power 10. Now, here I have given two different names. DF is the future, DP is the present. So that is how we put it. But anyway, this is more explainable if you put it D rather than DF, you can put it as D10 and DP is D0. D10 is equal to D0 into 1 plus G to the power 10. So that is how we can put it. And later we get the equation solved. You can see how it has been solved. 150 you can just take the other way. So 4 divided by 150 is equal to 1 plus G to the power 10. So 4 divided by 150 you can calculate. And when you do that, you get the 1 plus G to the power 10. But we don't need that. We need the 1 plus G. So we have to get the, if you get the 10th root of this right hand side, you have to get the 10th root of the left hand side also. So that is what we have done. So when you get the 10th root, now I will show you how to get the 10th root from your calculators. From Casio calculators, you can have a power calculation by pressing the arrow mark. And you have a, say, you can put a bracket. Within bracket, you can say 1 over 10. And you calculate that, then you get the 10th root of 4 over 150. That comes to 1.1031. G is equal to 1.1031 minus 1. So that is 0.1031. That is 10.31%. Right. Now we have already got the growth rate that is 10.31. Applying this value to the one stage model. So P0 is equal to D0 1 plus G divided by K minus G. So you apply that G into this calculation. So you might get K. By rearranging the equation, you can solve it for K. Now that solution will give you the K value, that is 17.66%. The required rate of return for the Blue Diamond Corporation is 17.66. Now you can see the required rate of return is higher than the growth rate. That is the normal type of growth. It is not an abnormal growth. So therefore, we can use or you can apply one stage model of dividends. Later, we discussed this substantial annual growth of dividends. And there we found that we are not in a position to use this one stage model. So we have to go for the two stage model that we have discussed. If you want, I can just explain the things on the board. Do you need that explanation on the board? What do you think? Have I to explain that on the board? Right, I will. Right. Now, I want to just explain the example on the board. Now the question says, the common stock of the Blue Diamond Corporation is currently selling at $60 per share. Dividends per share have grown from 150 to the current level of 4 over the past 10 years. So now these have given out us certain information. Now when I say 150, 150 is the initial dividend. Initial in the sense that is the zero, D0. So I will put it as on the board, D0 equals 150. Now, first of all, what we need to do is we need to jot down the available information in our sheet. D0 is equal to 150. Then we can say after 10 years, it has come up to $4. So we can say D10 is equal to 4. Therefore, now what we need to do is we need to calculate the growth rate first. Growth rate first. Now, what is the formula which we can apply? So we can say D10 is equal to D0 1 plus G to the power 10. D10 is equal to D0 1 plus G to the power 10. Now you can remind or you can just recollect and see this particular thing. D1 is equal to D0 1 plus G to the power 1. So we don't need to put 1 here. So this is the first thing. Then if you say D2 is equal to D0 1 plus G to the power 2. That is how this particular relationship comes. Now we can apply these things here. D0 is 150, D10 is 4. So we can say 4 here equal to D0 is 150. We don't know 1 plus G. We don't know the G to the power 10. Right? So what shall we do? Now this is unknown thing here is G. So we have to calculate G here. Therefore what we can do is we can rearrange this relationship. You can put it as you divide divide the both sides with 150. So you will get this 4 over 150 equals to 1 plus G to the power 10. Now this is a little cumbersome thing. Why? You have a power calculation. 1 plus G to the power 10 is there. So that is a little embarrassment for us for the time being. Then we can get rid of that. How do we get rid of that? We have to get the 10th root of this right hand side. 10th root. So then it will become 1 plus G. It will become 1 plus G. So it's like this. If you have 1 plus G to the power 2, that is what you call 1 plus G square. So you have to get the square root to get it 1 plus G. When you have 1 plus G to the power 10, you have to get the 10th root to put it as 1 plus G. So what you do is, you get now this is an equation. If you do something to the one side of the equation, it has to be done to the other side also. Otherwise the balance will be out. So therefore what we can do is, you can get the 10th root from this side. So when you get the 10th root from this side, you can write it as 1 plus G. This side also you have to get the 10th root. 10th root means 1 over 10. Power 1 over 10. Now we can to go for the calculation. How are we going to get that calculation? Now, if you can use this type of a calculator, it is very easy. And what you can do is, this is a power calculation. Now, you have to get 4 divided by 150 equals some value. Then you have to get yx right. You get the value 1.10331. 1.10305. So we can put it as 1.1030 or 31. In the paper, it is yeah, it is 1031. To get the value here, 1.1031 is equal to 1 plus G. So from this we will get G is equal to this one, you can take it to the other side, 1.1031 minus 1, that is 0.1031. In other words, we can put it as 10.31%. This is the growth rate of dividends, 10.31. Now, if you have a scientific calculator, this is a very simple thing. I think all of you can make use of a scientific calculator and get this calculation done. Any issue, if you can make use of a calculator without any issue, you can do that, right? Okay. Now this is not the end of the question. The required thing is to calculate the rate of return. Now you have already calculated the growth rate. And if you know the growth rate, you are in a position to calculate, and the price is also been given. What is the price given? Present price. Present price is what? $60. Currently selling at $60. So you can say P0 is equal to 60. P0 is equal to 60. Now, is it okay to write here? Can you really see that? Okay. Now I will put the one stage model. So P0 is equal to P1 divided by A minus G. P0 is 60. D1 is D0 into 1 plus D. D0 is 150. 1 plus D is 1.1031. Now, this comes, I substituted this D1 with D0 into 1 plus D. D0 is 150. 1 plus D is 1.1031. Divide by K. K we don't know. K minus G. G is 0.1031. This is the equation. When we solve this equation, you can get the value of K. When we solve this equation, we can get the value of K. Now we can cross multiply 60 into A minus 0.1031 equals to we can get the value here, 1.5 into 1.1031. You will get that value, 1.5 into 1.1031. That comes to 1.6546. 1.6546. So therefore, we can say K minus 0.1031 is equal to 1.6546 divided by 60. That comes to 0.02757. Then K is equal to 0.0275 plus 0.1031. K is equal to 1.6546 divided by 60 plus 0.1031. I think there's a small mistake in the note. When you work it out, you get a different answer. 1.6546 divided by 60 comes to 0.1031. 0.0275. You can say 0.0275 plus 0.1031. You get the answer 13.1306. That comes to 13.06%. There's a mistake in the note, the example, worked out example. This is the correct one. Oh, anyway, now, even though there's a mistake in the example, now when you work it out, you will find it. If you work it out. So that is what you have to do. Right. Anyway, any questions on this? Do you have any issue on that? Is the explanation clear? Yes. Nisansala, is that okay?
So the current level of dividend is $4 now.
Pardon?
Current level of dividend is $4.
Current level of dividend, growth rate.
Yeah. Why are we calculating next D1? Because the 10th year only the current selling price is 60 rupees. $60.
No. I just gave it as an example. Now this is the formula. Like this doesn't. I mean, we don't need it. This is the one we need, right? Here it should be. No, this is the particular thing. I mean, this is the formula, right? Now we equate the formula with this. Now, in order to get the growth rate calculated only, we can use this formula. Otherwise, we don't need to use this. This is the formula. Real formula is this. So, as it is, we just use that formula. That's what we do. Now, what you ask is, why do you go into D1? That is what you ask, no? So, there's no issue.
Because the current selling price is $60 at the 10th year, no?
No, not the 10th year. We call it the current. It says this. The common stock of the Blue Diamond Corporation is currently selling at 60. Dividends per share have grown from 150 to the current level of 4 over the past 10 years.
Current level is 4. So we have.
Oh, yeah. Right. Correct. You are correct. Now, yeah. Actually, I just got that in the wrong way. 60 is the current price, yes. Yeah. Since it is the current price, you can put it as P10. Yes.
It's not 1.5.
Yeah, it is P10, yes. No, if it is P10, we will get this way. We will get this way. Right. I agree with you. So then this has to be changed. Then we have to write this way. P10 is equal to P0 1 plus d to the power 10 divided by k minus 1. So this is the way we can write it. Okay. Now this we have already calculated because we can just get it from this. Because 10th year dividend we have already calculated now. That is 4. Divided by a minus d. A minus d is a minus 0.1031. P10 is 60. Then we can say 16 to a minus 0.1031 is equal to 4. A minus 0.1031 is equal to 4 divided by 60. K is equal to 1 over 15 plus 0.1031. We can see what is 1 over 15. .066. So then it comes to 0.1697. That is equal to 16.97. Right. Thank you for your comment. It's correct. Now, if you get this type of a thing, you have to clearly understand that. I think you all have to be vigilant. Then, if there's a mistake, you can really identify that. Right. Now there's a small question. Now I will read the question for you. The Orient company is expecting earnings per share next year to be $5. Make sure it is next year's earnings per share. If earnings have been growing at a rate of 8% per year in the past, and this growth is expected to continue in the future, determine the current required rate of return for this company's stock. Assume a dividend payout of 60% and the current price of 65. Now, this is a simple exercise. Can you do it? Is it clear enough? The writing is clear enough? I will read it again. The Orient company is expecting earnings per share next year to be $5. If earnings have been growing at a rate of 8% per year in the past, and this growth is expected to continue in the future, determine the current required rate of return for this company's stock. Assume a dividend payout of 60% and the current price of $65. Right, anyway, we will go to the presentation again. Right. Now this valuation process, again, we will go through this presentation. I think you can just go through the questions and get a good idea about it. Now we will go to a little challenging type of area. Now when you go through the valuation approaches, you will see discounted cash flow valuation is the normal way of having a valuation. Or it relates the valuation of an asset to the present value of expected future cash flows on that asset. So this is the normal valuation process. And there's a thing called relative valuation. it estimates the value of an asset by looking at the pricing of comparable assets relative to a common variable like earnings, cash flows, book value, or sales. So that's what you call the relative valuation. Then there's another approach, we call it contingent claim valuation. Now, what do you mean by contingent? Contingent in the sense it's a little doubt. There can be a claim. If there's a claim, what would be the valuation? So that type of a thing. Now, uses option pricing models to measure the value of assets that share option characteristics. Now, I think it's a little challenging type of a concept where you need to think about. Now, as an example, say there can be alternative claims by the people. Now, that comes only with different situations. If that situation arises, a claim can come or some withdrawal or whatever it is. So such type of valuations are called contingent claim valuation because that valuation depends on the expected claims for that. That is why we put it to an option pricing model. You know what is an option? Option is a particular right to be used. It is not an obligation. A person can exercise that right if he wants, if he likes. So that is what you call an option. So if an asset is vulnerable to such options, so that asset's valuation depends on the contingent claims. That is why we put it as a contingent claim valuation. Now, there's a schematic explanation here. Now, valuation models, there are 4 valuation models given here. DCF is the normal model, discounted cash flow model. That's what we have now gone through. Then relative valuation model is another type of model where you go by the stock market indices like PE ratios, equity and balance sheet valuation type of a thing. So book values, liquidation values and also those are relative valuations. It is not dependent on the discounted cash flow. It depends on several indicators. So such valuation is called relative valuation. Then economic profit model. Now economic profit model is the return on equity type of things where you have to go through and just have a look on that on the basis of economic profit. Then the dividend models, even though we have used the discounted cash flow here, dividend models have a separate categorization, and those dividend models have been taken separately, but it is also a type of DCF model, but we don't put it as DCF models, but we put it as a specific dividend models, and that's what we have done now, dividend discount model and the constant growth rate model. So that type of things. So you can get a clear idea about different valuation models. Now, when you get the discounted cash flow valuation, so you get this. Now, you have to be familiar with these notations. Now, this notation is now when you put this type of now you can just focus your attention onto this cross here. Now, when I put the cross on this particular letter, we call it sigma, and this is capital sigma. Capital sigma denotes a summation. Now that summation occurs from t equals 1 to t equals n. So I will show you the meaning. Now where n is the life of the asset, number of years. N is the number of years life. CFT is the cash flow in period t. CFT is cash flow in period T. So that means cash flow in period 1 is CF1. Cash flow in period 1 is CF1. Then R is the discounted rate reflecting the riskiness of the estimated cash flows. The discounted rate. Now, if the discounted rate is lower, the meaning is estimated cash flows are not that risky. The risk is low if the discounted rate is low. But if the discounting rate is higher, the meaning is you have a high risk of estimated cash flows. I think that, of course, you will understand. I think this notation is now clear. Do you have any issue on this? And I can just show you the way it can be expanded. So you can just get the first term of this summation as CF1 divided by 1 plus R to the power 1. So that is the first term. The second term would be CF2 divided by 1 plus R to the power 2 plus CF3 divided by 1 plus R to the power 3 plus CF4 divided by 1 plus R to the power 4. Now it goes on and up to N. So the last one would be CF N divided by 1 plus R to the power N. So that is how this summation is expanded. I think that that gives some meaning. And all these letters being described here. N is the life of the asset, number of years. CFT is the cash flow in period T. R is the discounted rate. So this is how the discounted cash flow evaluation is explained. Now there's another valuation method, equity valuation versus firm valuation. Value just the equity stake in the business. Value the entire business, which includes, besides equity, the other claim holders in the firm. Now here, the equity valuation in the sense, now you value the company on the basis of equity only. You all know, in a business, you have the equity capital. You have the equity capital. Now that is normally understood as market capitalization in some cases. Market capitalization. So the market capitalization is the price given for a share in the market. And it is being multiplied with the number of shares, equity shares, then you get the capitalization, market capitalization. So that is equal to the company value in normal cases, but that is one way. That is what you call the equity valuation. But when you say firm valuation, in addition to the equity, so there can be several other things in the business. So that is also been taken into consideration. So that is what you call entire business value or firm value. The equity valuation means the value of equity is obtained by discounting expected cash flows to equity. The residual cash flows after meeting all expenses, tax obligations and interest, and principal payments at the cost of equity. So that is how the equity valuation is made. Now, when you say cost of capital or cost of equity is KE. Now, here the cash flow of equity means residual cash flows after meeting all expenses, tax obligations, and all that. So that is what you call the return on equity type of a thing. So that is what you call the cash flow of equity. In other words, you can say earnings or returns after paying everything, after tax. Normally we call it after tax profit. Then dividend growth model that we have already discussed. Dividend growth model. Future dividends and their present value. No, that's what we did. That's what we did. Now you can just look at it on a graph. Now when you put the years in T and the value in dollars, this is a particular year, and from that year dividends grow this way. Present value also at a lower rate. Now here again this is described when G is greater than K. Now you can't use the constant growth formula. If this is the case, then the two-stage model has to be applied. Those things actually we have already discussed. Now these are the limitations. These are the limitations of a two-stage model. Now just look at the first one. Defining the length of high growth rate. Now in you all have now experienced, we just talked about two-stage dividend model where the dividend growth rate is very high at the beginning. So the limitation is it is very difficult for an analyst to see the length of a high growth period. It can be 5 years, it can be 10 years. So that all depends on the company's profile and the management's attitudes and all. So therefore, it is not an easy task to see the length of high growth rate period. So that is a limitation for two-stage growth model. And the other thing is if the growth rate is not constant for some time, it is a difficult task. That's what I told you. We need to use several analytical methods to arrive at valuations when the growth rates are not constant. So there it says overnight transformation of growth rate. So it always comes in a very, very volatile type of growth rates. Sometimes the growth rate being estimated at a lower or underestimated. Sometimes it is overestimated. So this is another problem for this type of things. Now I think it is better if you can think in these terms when you work out sums also, because the matter doesn't tally with the normal questions or whatever, but we have to look at the reality. In the reality, there can be several challenging situations we have not discussed under a theoretical form. So that is the most challenging thing in this investment analysis, because you need to understand what are the types of limitations for all what we have done. So therefore, now we need to have a relaxed type of thinking process, not just doing mechanical type of calculations or so. Rather than doing mechanical calculations, you have to get a real understanding about what you are doing. So that is why we need to be very much concerned about limitations. Now I will just put it again. Defining the length of high growth rate. So that is a very big challenge for any analyst, because if you just look at a company, you can't say how long this high growth period been existing. So that is the first limitation for a two-stage model. So then overnight transformation of growth rate. The growth rate has been transformed at any time. And overall underestimating growth rate. Now growth rates to be estimated. Now I will ask you, what are the types of methods which you can suggest to look at the growth rate of dividends of a company? How do you do it? I will just ask that question now. What is the way of arrive at a dividend growth rate of a particular company? Now, even you can get an example from Sri Lankan stock market. How do you arrive at the growth rate of dividends? Yes, you can just put the answer in two sentences like. Just to say something. Is the question clear? Now, what I am asking is, for a quoted company, how do you arrive at the growth rate of dividends? That is my question. How do you arrive at the growth rate of dividends? Yes. How do you arrive at the growth rate of dividends? I need one or two sentences, or you can just talk and say, how do you arrive at the growth rate of dividends? Now, in the questions you find the growth rate is so much and it is there for some time and all that. But in practical terms, how are we going to determine the growth rate of a particular dividend growth rate of a particular company? Just to say something? Because it has to be done practically, no? Therefore, what are the methods which we can apply for that?
The growth rate in share price?
Yeah. Yeah.
Growth rate in share price?
Growth rate?
Share price growth rate?
Share price growth rate. Share price growth rate. No. No. Now, I think you have come to a certain level, but you have not reached that. Now, what I am asking is, with the available information, how are we going to estimate You can arrive at a certain estimate of dividend growth rates. Now, for that matter, even if you can have an idea about the earnings growth rate, that is also okay. That is also okay. Yes, Laknath has given a good explanation. D2 minus D1 into D1 divide by D1. No, that's the rate. That is the way of calculating that. So how can we arrive at now, say, in this particular dividend growth models, what is our assumption? The growth rate is constant. No, that is our assumption. So we don't know whether that assumption is really valid. That's what we have to check. Yes, Rasika Jailath has also given the same thing. So that's okay. Now that is the way of calculating it. But our question is not the way of calculation, but we have to see how we can arrive at growth rate and whether it is a constant one. So that's what we need to understand. So we need to check whether it is constant growth rate. Now, for example, say you just say you have selected a company, say Access Engineering. You have selected that company and see that whether how much dividends they have declared in the year number 1 or so. Then you can just check the dividends declared in the year number 2. There, as Laknath said, we can calculate the growth rate of dividends in a realistic manner. Right. Then we have to go for the next year and see again the growth rate of that year also. And we need to check whether the two growth rates are similar. At least closely similar. It may not be 100% similar, but there can be a close similarity. Now, if you can do that for a couple of years, say 5 years, and see that the growth rates are not that different, so there's a small variation in the growth rate, so then we can approximately say that growth rate is constant. Like for that, we need figures for the past 5-6 years. Is that so? Yeah. That is how we do it. You can either take the growth rate of dividends or growth rate of even earnings. Both are same. Both are same. Earnings means the after-tax profit. That after-tax profit can be taken into consideration, and you can work it out for per share. Per share earnings per share, IPS. The earnings per share you can see, and you can get it for several years and see how the growth has taken place. Whether that growth was a constant one, even for the history, the past years. And you need to have a projection for 1 or 2 future years. So that is how it is been done. Right. I think you appreciate what I say. Laknath has given the methodology. Rather than the methodology, you need to see how it can be applied. Just to see the reality. So that all of you, I just advise all of you to go through the Colombo Stock Exchange website and see all the details of companies. What you need to do is you just log in to csc.lk, that is the website, and you just Google it and get it. And after getting it, you will find several information, and company-wise information also you can get. Now, in those company details, you will find the beta of the company stock, their dividends or whatever. All these can be taken from that information sheets. And with a more intensive type of analysis, you will be able to find out the growth rate of earnings or growth rate of dividends and see whether this is now for you have to go for several companies, not only one company, and see how these things are going on. So this is the practical thing which you have to do. Even I suggest if you can visit the stock market. It is in the it is operated in the World Trade Center building. You can just have a look. I think you can call them and just get a get an appointment, or you can visit that place and see what is really happening there. And you can see the screens and all. So that's a nice, very interesting type of a thing which you can observe. Right, now I just want to tell you, this is the challenge. It is not like, working out sums or whatever. It is only a methodology. So what you need to do is you need to see how you can look at these things, how you can analyze these things in a real situation. I think nowadays the stock market is very active, and it has surpassed the 11,000 mark also. I can remember about a month back or 2 months back only, the 10,000 mark was passed. You see the point now. Now, as investment and portfolio management students, you have a great opportunity to look at these stock market operations in Sri Lanka, because it has now come to a very active position. I don't know whether you really understand the reason for that. The reason is there's a very low interest rate regime is prevailing now. The reason for the stock market activities are the reason is that, the main reason is that, because the investors find that they don't have any investments, they don't have any incentives for investments in other type of places, especially the government stocks or debentures or whatever. Those rates are very low. Whereas in the stock market, you can expect a higher return, since the stock market is now very active and we have a bullish market like. That is why the price index has gone up so much. Okay. Now, all these things I just give you because you need to think in terms of realistic situations. Okay. Right. Now, I just give you a small assignment here. This is for the interest of your development of your attitudes, your thinking and all. I will give you some companies, and so what you need to do is you need to just go through that company and see the dividend information, and just arrive at the dividend growth rates and the beta values and all. I will give you only 3 companies. Right. Now you can note down these companies. All these companies are quoted in the Colombo Stock Exchange. Right now I will give you these companies and you have to find out the betas of these companies, the dividend growth rate of these companies using 5 years past data. Right? This is a type of an assignment where you need to do. Now you take down these companies. Abans Electricals PLC. Abans Electricals PLC. Access Engineering PLC. Access Engineering PLC. There are altogether 5 companies. Amana Bank PLC. Agstar PLC. Aitken Spence PLC. Right. I will now what you need to do is you need to find out the beta of these stocks. Now beta is given as at a certain date, and that beta you need to get in respect to the all share price index, right? All share price index, not S&P 20. Yeah? All share price index basis you have to get the beta. I will put down those things on the board. Right. Now I have just given the things. Advanced Electricals PLC, Access Engineering PLC, Amana Bank PLC, Extra PLC, Icon Spence PLC. What you need to do is, you need to get the beta values. Those are ASPI related. You need to go to the Colombo Stock Exchange website and go to these companies' details. There are appropriate links. So as a student, you need to understand how you can use a website and extract in the information for your use. That is one of your part of your study. Then you need to check the past dividends and growth rates for these companies, and the PE ratios also, price to earning ratios. I think those things are available in the website, and if you go to the company profiles, you will find all these things, and you can see how you can use this website for your information requirements. So that's another study you need to do. I think the things are clear. There's no big issue here. And when you do these things, you will get some more insights into this study activity. I think that is the most important thing. You will get some innovative ideas when you go through the website. So that is the necessity. If you don't do anything, you can't get that. You have to participate actively in these things. Then only you can learn. Otherwise, this will become a very mechanical type of a thing, routinized thing, and it's very boring. And you don't find the interest of it. The reality of interest. Interest in the sense, you will see how satisfied you are after learning all these things. And you are in a position to give so many projections for something. You I think, develop a sense, a vision. That is what you need to do. Okay. Any question on this assignment? Are you confident about this assignment? You can do that? Yeah. Deadline anyway, I will give you 2 weeks. Not the next week, week after this. This is not a big task, but I just give you, because I will give you time, because you don't get so much. I think it is enough. A week is also enough, but I don't know. I will just give you 2 weeks. Okay. 12th can December 12th. Exams. No, I mean, I don't think that this will really, just interrupt your work schedules or whatever. Just do it. I mean, you don't need to, assign so much of time for this, but just to do that. You don't need to do any calculations or whatever, just to look at it. That's all. Nothing else. But the results can be given within 2 weeks. No, I think even you have examinations. It's a matter of just looking at it now, just like you look at the phone or whatever. Just nothing else. There's no big task here. You don't need to do any calculations. Just to look at it and just get it. That's all. Yeah. Okay. Okay. What I want to tell you is, you can, anyway, in casual manner also you can do it. Don't take it so serious, but that's what you need to do. Anyway, you do it, then you will get a very good understanding. Now, actually, I am just discussing the details of this valuation and all, and the growth rate to be estimated. So that's a very challenging task. And you can see, if you go by the company details, you will see that whether the growth rates are constant or growth rates are very irregular and all that. So that you can see. That all depends on the company. I know these things actually we have already discussed. Vision frontiers, the capital market line and all that. Security market line. Rate of return. Right, now the particular problem comes. Now this particular model is called another model, residual income model. We have valued only companies that pay dividends. Right, now this is the question. Now if you go to the Colombo Stock Exchange or some other exchanges website, you will find some of the companies, they don't pay dividends. And how can you go for a dividend growth rate and do the valuations? It is impossible for them. But then how are we going to do that? That's what now we are going to discuss. There are many companies that do not pay dividends. It turns out that there is an elegant way to value these companies too. Now we call that model residual income model. Residual income model. Now we need these things in order to do this valuation. Inputs needed. Earnings per share at time 0. Earnings per share, now it is available in a normal stock market profiles. Now you have all these company profiles in the stock market. If you go to the company and the profile is available there. Now this is the way it can be done. These are the inputs needed. Earnings per share at time 0. Time 0 means the present time. Book value per share at time 0. Earnings growth rate and discount rate. So these are the inputs needed. Now how are we going to arrive at the earnings growth rate? There you have to go through the historical earnings and see how the earnings been grown. It can be a minus growth rate, maybe sometimes. Then you have to just arrive at the discount rate also. Now residual income model, you have this formula. B0 is the book value plus EPS into 1 plus D minus B0 into K. K is the discount rate or internal rate of return or required rate of return. It's same as our dividend discount model, but it doesn't go into dividends, but only earnings. But there's a small difference here. In our dividend growth, the one stage model, you have P0 is equal to D0 into 1 plus D divided by K minus D, whereas here you get several other things. Now here you just deduct the book value multiplied with the rate of return, discount rate. And added to the book value, this amount. P0 is that. And even you can have it in this way also. EPS1. EPS1 means EPS 0 into 1 plus G minus B0 into G divided by K minus G. I think this particular formula is a simple formula, but it has some additional things than the one-stage model. But you can see there's no dividends here, because in the case of a company where dividends being not declared, how can we arrive at the value of that company, the company share or whatever? So therefore, this is a very important model for such companies. We call it residual income model. Now there's another way of valuing stocks. PE ratio is 1, P divided by E. PCF means the cash flow. P divided by the cash flow, and P divided by the sales sometimes. P is the price. Based on comparable firms, estimate the appropriate PE. Multiply this by expected earnings to back out an estimate of the stock price. Right. Now, this is an important and very interesting type of thing where now you might wonder how you can just apply these dividend discount models, one stage or two stage or whatever, if a company doesn't pay dividends. Even if they pay dividends, if the dividend growth rates are not constant. So how can you arrive at such companies? So this is another issue. But then if that is the case, we should have a methodology to arrive at the company value or company price per share. So this is another method, and we call it residual income method. Residual income method, where you need to have the book value per share. What do you mean by book value? The sole price. Or at the beginning you have a value. So that is what you call the book value. But if it is quoted in the market, then there will be a market value at different times. Now, this formula actually now, even though these are two formulas, now these two things give the same meaning. EPS 0 here, that is earnings per share, present earnings per share into 1 plus G minus B0 into K divided by K minus G plus B0. Now, rather than doing this, we can have this also. Now, this is a simplification of this. EPS 1 minus B0 into G divided by K minus G. Okay. Any questions on this? Any questions on this? No. Asika, no. This is not the real big one. Don't take it so serious. I have just given you a small exercise, because if this is the examinations assignment, I may, you have just underestimated your course. No, nothing. This is just a exercise. Even I can't say it is an assignment even, right? So this is for your sake, your interest. I have given it because it's for your understanding. So this is not the assignment, the examination assignment, or there won't be any marks added here, right? What I have given here is in order to give you a certain understanding, certain insight into these operations. I just recommend this exercise. It is a classroom exercise type of a thing. Don't take it so serious, because no, that is the attitude you have, because you should not have that type of a thing, because this will not really interrupt your normal work. Don't take it that serious, right? But I will give a better assignment. I mean, that will be a challenging one. That will be a real challenging one, not as this. But this is just an exercise, a small exercise, a classroom exercise, where you need to do in order to get a good understanding about the subject. That is a necessity. Now, if someone thinks that this is not necessary or this will interrupt their work, don't do it. Because our objective is to have a good understanding about the subject, and you can make use of that knowledge in your decision-making situations. That is the objective of this course, right? And you can enhance your understanding by doing this type of exercises. This is the participation. So then you can apply those ideas in your decision-making situations and even in your examination. That is the necessity. Okay. Right. And we just went through a certain methodology where we don't find dividends or growths or whatever it is. Still, we are in a position to calculate a company valuation or stock valuation by using that formula. For that, you need the earnings per share, growth rate of earnings, book value of the share, and the required rate of return. If you have those values, you will be in a position to calculate the price of the share. In a situation where you don't have any dividend information. But a company, if the company doesn't pay dividends, the company earns something. Otherwise, the company should not be there. No? Therefore, for any company, you can make use of this formula to determine the value of the stock. Any questions on that particular formula? Now you get alternative type of methodologies to use when you do not have necessary inputs. So that's another alternative. So therefore, our task of getting the stock value of a company can be achieved even without dividends. Now, if you look back into your studies for the last couple of weeks, you will find that we have gone through several methods of company valuations, stock valuations, returns, risk calculations, and all sort of things. But all are useless, worthless, if you do not have an understanding. The understanding is the most important thing rather than working out sums or whatever. Now you found that at the beginning we started with the one stage model where you say that there's a particular condition to be fulfilled. That is K has to be greater than G. K is the required rate of return that should be higher than the dividend growth rate. If not, you are not in a position to calculate the price by using the one stage model. If the growth rate is higher than the required rate of return, then invariably we have to go to the two-stage model. But there also, you need to have dividend growth constant. Now that's a very rare type of phenomenon if you can observe in companies. You don't see companies with constant growth of dividends. Very rarely you have that type of companies. But you might get some companies with approximately constant dividend growths. So it's like this. So in 1 year it might be 8.5. The other year it might be 8. The other year it might be 7.9 or likewise. You have that type of dividend growth, but we can just put it as a constant growth. But you can see most of the companies in 1 year it has a growth of, say, in 1-2 years, I mean 2-year period. No, in 2-year period you might get 8% growth rate. In the next 2-year period it might be 4%. Likewise, you have very volatile growths in dividends, or even in some years it might be minus. That can happen. So therefore, you need to think that there can be several alternative ways to arrive at the price of stock. And that is one of that particular methodology is residual income method, what we have discussed now. We will have some examples of that time to come. Now we can have a break and we'll start by 10:45. So you can have a look on this formula, and we will work out some problems when dividends are not being declared for some companies. We will start by 10:45. Come back to the session. I think now you have already gone through this formula, and you see the types of inputs we need in order to have a calculation and determining the price of the share. Now, first thing is earnings per share at time 0, that is EPS 0. Book value per share at time 0, that is B0. Earnings growth rate G, discount rate K. Discount rate is the required rate of return. Now, we go by this formula. This is the earnings per share, present earnings per share, and it has to be multiplied with 1 plus G. Then deduct the book value and it is to be multiplied with K. And it has to be divided by K minus G, and the whole thing has to be added to B0 again. And this can be simplified into this. Now, EPS 0 into 1 plus G is taken as EPS 1. Minus B0G is a part of this, and it has to be divided by K minus G. Now, this is the formula. So, I think rather than going into this, it is better if you can do this, taking this. And I will put it on the board. Now we have, I have put on the board the residual income model, where you have the percent price, and this is EPS1, that is the earnings per share in the first year, minus B0 into G. B0 is the book value of share, divided by K minus D. K is the required rate of return, D is the growth rate. So the things are given here. And this will enable any person to arrive at the share price even without dividends. So there are situations where the companies don't declare dividends and don't pay dividends. Even sometimes they pay dividend in 1 year and other years they have not paid dividends. So therefore it is difficult for us to see the growth rate and all. Then we cannot go by the dividend discount model or whatever. Therefore we have to go by this residual income model. Right. Now here the issue is we need to go by the book value. So there you need to have that book value also. Now I will show you the stock market daily and stock market monthly for you to just look at it and see how you can get some information from them. Very important information. Now this is the stock market daily, where you have this indices. Now all share price index, you have this 10,132. Now this is as at 1st of November. And there's another one called S&P Sri Lanka 20 index. There also you have a index, but our main attention goes to this total return index, because the market returns being calculated by using this total return index. And now that also given in two bases. One base is all shares and the other one is the 20, S&P 20. And there are several other indicators given here. The total turnover has given. Then the top 10 contributors to the change of ASPI been given here. And the names of those companies are given here. Now they have given the codes for that companies. I think, yeah. These are the companies. ELC or CIC. So I have no idea about these notations, but those are notations for different companies. So you can just look at it and see what are these companies in the stock market. I think this is CARG. I think it looks like Cargill or whatever. CCS is Ceylon Cold Stores. Now these are the increased, now share index has been increased by this amount as per these companies. The highest increase was contributed by this company, CLC. Now this is dividend yield. Here, 2.60. Now all these things are general indices. PER is the price earning ratio. Price earning ratio, 12.28. PBV is price per book value, that is 142. Now in general, all stocks are valued 1.4 times of the book value in average. Dividend yield is 2.63. If you take the whole number of stocks, there you have 2.63% dividend yield. Now as a whole, then all the companies, there are 288 quoted companies. Now in this particular day, 252 companies engage in the transactions. That is what it means. So that means 36 companies have not been engaged in any transaction in this day. Right. Now this is the information where you can gather from the stock market daily. Now, when you say the 10 contributors, either into the upward movement or the downward movement, that is why they have given it this way. Now, these 5 companies have contributed towards the downward movement. That is what it means. So, in other words, either side, these companies have the highest change. That is what it means. I think you got my point. Now just look at upward type of things, CLCN, NIFL and all. Now those have been, the points been went upward. Now in CLC company, 44.4 points went up. In NIFL, 5.5%, 5 points went up. In SUKI, BUKI, 4.5 points went up. 2.7 and 1.4, the other companies. Those all went up. Whereas Expo, it went down by 24 points. And the other one, BIL, went down by 8.7 points. And JKH is a John Keels, it went down by 5.2 points. Haley's, it went down by 4.6 points. And SLTL, it went down by 4.5 point. So that is how the things been changed. So the main contributors means either side, either an increase or decrease at a higher rate. So these are the most high increase or decrease in that particular day. Now, if you go to the monthly one, now this is the monthly one. Now the turnover is given here. Price index is also given. Now you can just see in the month, it was started with 8,997.60. Closing now, this is for the month of September, right? As I told you earlier, this came up to 10,000 mark in the month of October, I think, end October. Now in November, not in November, in mid-November, it surpassed the 11,000 mark also. Now you can see there was a 5.14% increase during the month. During the month, there was an increase of 5.14. If you take the return indices, also the same. Yeah. Return indices also 5.14 increase. Now I am referring to the all share price index. Now this really gives an indication about the market return. This is the market return for the month. Now how are we going to get it for an year? There's a methodology. Now the difference, or what you call, that is the increase or growth rate, market rate, or whatever. So this is the market rate for the month of September. Market return or whatever. Market return 5.14% for that month. If you annualize that, how do you annualize it? So can you just annualize it? Either you can multiply it with 12, so then there will be an annual growth of 61%. So that is a big growth. But however, we need to do it on effective basis. So therefore, we should get 1.0514 to the power 12. You get 82.48. So that is the real growth. But anyway, so that's a big growth for the market. If you take only this month, it is only 5.14. And there are several other details given here. Now another summary is given here. Now in the month of September 2021, equities of 265 companies being transacted. Debt, equity, or not equity, debts, debentures. Only 3 companies debentures being transacted in the month of September. Closed-end funds, no, nothing. Listed companies at that time only 287 actually. Now it is 288. In the month of September, it was only 287. And there have been 21 market days. 21 market days. Now you can just see the sectors here, because this is also an important analysis. you need to see what are the movements in different sectors. And you can just look at these sector movements and get an idea about the sector performance. Now you see, in bank, finance and insurance sector, started with 24,875 and it has closed by 25,000. So that's a growth. There's a growth of 1.26 in the month. Beverage, food, tobacco, that has a growth of 0.10. Chemicals, pharmaceuticals has a growth of 0.92. Construction engineering, it went up by 7.34. And diversified holdings went up by 7.61. Footwear, textile went up by 9.06. Healthcare went up by 13.83. Hotels, travels 3.37. Investment trust 1.18. IT, that went up by 61.55. And land property went up by 4.78. Manufacturing went up by 6.08. Motors went up by 1.44. Oil palms, that has a minus growth, decline by 0.8. And plantations went up by 3.43. Power and energy went up by 1.32. Services went up by 2.81. Stores supplies went down, that is 1.52. And telecom went up by 0.12 only. Trading went up by 3.51. So these are the sectors. Now, what do you mean by that? Now, the market has been categorized or sectorized into different types of sectors. Different sectors being given, and altogether 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 20. There are 20 sectors altogether. Now, out of all these sectors, in what sector the highest growth occurred? Highest growth occurred in IT. I think that is compatible with the ongoing situation, I think. Now for everything, now we started doing everything in online. There the involvement of IT is so much. And IT has a relevant growth of 61.55 in that month. That shows how the IT became active. Then the second growth occurred in the healthcare sector, you have seen, 13.83. Now it really reflects the real economic situation in the country. Now you see the bank and bank finance and insurance being grown by very, very small percentage, 1.26. At the same time, you can see the construction engineering has grown up by 7.34 because though the COVID pandemic was there was no stoppages in the construction work. It went through without any interruption. That is why they have had the growth of 7.34 even in the midst of these pandemics. Even textile didn't have a much decline. They have a reasonable 9.06 growth. Now these things can divulge so much of information with regard to the market and the economy. This is the market performance. Day by day, they have given it. Now in in 1st of September this happened, in 2nd of September this happened. Likewise, they have given all the indices daily. Now you can see ASPI movement during September 2021 and S&P movements also been given. Now see how the movements went up. Here. There were some declines in between, but it ultimately it went up. Now if you compare this particular point and this point, you can see an increase, overall increase. And here also, S&P also the same. Now it started from here and ultimately it went up here. So the two things have a difference. Now here also some details were given. Foreign trading. Now you can just look at these company names also. Now when you say market capitalization, now what they do is they take the companies and the companies with transactions on the last day and shares being in trade and the price. When you multiply that, you get this. That is what you call the market capitalization. Now, all the company shares being taken into consideration, the number wise, and the share price is taken, and the multiplication will give you the market capitalization of that particular company. Now, Expo Lanka is, its market capitalization is 389 billion 516 million 813,750. So that is the market capitalization of Expo Lanka. So as at 30th September 2021. And if you take LOLC Holdings, its market capitalization is now its number of shares in trade 475,200. No, 475,200,000. And the share price is 620. And capitalization is 294 billion 624 million. 294 billion or 294.6 billion, we can say. And Yon Keels 197 billion. Commercial leasing and finance 175 billion. Ceylon Tobacco 168 billion. Brown's Investments 146 billion. LOLC Development Finance 113 billion. Commercial Bank 95 billion. Dialogue 88 billion. Distilleries 82 billion. Ailey's 80 billion. Valuable 70 billion. Melstar 69 billion. Nestle 67 billion. So likewise, all you got all these capitalizations. Now this market capitalization changes every day because When the price changes, the market capitalization also will change. Now you can just look at the names of companies here. Royal Ceramics, Cold Stores, Carson's, all are given here. Now you can have a good idea about the companies which are in the Colombo Stock Exchange, quoted in the Colombo Stock Exchange. Asiri, CT Holdings, Selinco Insurance, Amas Holdings, Lion Breweries, Browns, LOLC Finance, Royal Ceramics, Sampath Bank, Cargills, SLT, Nestle, Valuable, Dailies, and all that. Those are the household type of names in Sri Lanka. Singer Sri Lanka, Central Finance, Ceylon Beverages, Union Assurance, all are given here. Sanatha Development Bank, Grain Elevators, Jet Twin, Lanka Realty, Janashakti, Tokyo Cement, all are given. This is as at 30th September. Now they have given it on the in the order of market capitalization. Now you see at the beginning the higher level of market capitalization given. So we started with the billions of market capitalization. See, right now in that case the highest market capitalization is with Expo Lanka, that is 389.5 billion. LOLC Holdings 294.6 billion. Now these are the market capitalizations. Now in that order they have given. So you can see the smaller companies in terms of market capitalization down the line. Here, Maravilla Resorts, Laughs Gas, Beruval Research, Amana Life, those are smaller companies with low market capitalization. Blue Diamonds, right. Now these are the things. Now some of these particular companies being not transacted on 30th of September. So here, so such things were given as at the last date. Yes, 7th September, 18th October 2019. Later on, there were no transactions. That's what it says. The performance of these companies can be checked by looking at these things. There are low watch list also, that also you can get. Because what I need is to show you these things because you can have a good idea about the information available. This is not a separate task. These are day-to-day things which you have to do, because that all depends on your interest. Don't take it as a burden. Now this is a thing which you need to do as a hobby. Also you can do this. Nothing serious about this. And this the changes in the index for each sector has been given here. And change of directorates. Now these are the companies trading suspended. Adam Investments, Swarnamahal Financial Services, and these are all are been suspended. And there's a thing called second board now. That is, those are also some issues, undergoing some issues. Ceylon and Foreign Trades, Adam Capital, Lanka Cement PLC. Now the reason given was non-submission of financial statements for the quarter ended 30 September 2018. Non-compliance with corporate governance requirements. Now these are the reasons given for the suspension. Modified opinions of in the independent auditor's report. Lucky Lanka Milk Processing, City Housing and Real Estate Company, MTD Workers, Paragon Ceylon, Ceylon Printers, Standard Capital, Office Equipment. Now there's another one given here. Transferred out, Test Agro PLC. Now this was under the suspension, but now it has been released. Please note that the trading suspension on tests have been lifted with effect from 7th September 2021 due to the submission of the annual report for the year ended 31st March 2020 and the interim financial statement as at 31st December 2020. Right. Now, that company was fortunate enough to get the release from that suspension. Now these are the notice of annual general meeting by these companies. And these are the disclosures. Right. And there can be another disclosure with regard to the commercial banks debenture issue, Basel III compliant debenture issue of commercial bank. It has been given here. CA for the Finance also has a debenture issue. Right. Now these are the, now I just want to show you, and browsing through these things, I just want to show you that this information can be gathered from these particular publications. Right, now we will go to the presentation again. Residual income model. Now, in addition to these publications, now I just talked about the two publications of the stock market. That is, one is CSC Daily and the other one is the CSC Monthly. In addition to these publications, there are several other publications. Now you can just look at just go to the website and see that it is not a study matter or whatever. It's just a matter of, it's like reading a newspaper, reading a magazine, going through the phone. Going through the phone. Normally you do that every time. So you go through the phone, you go through the Facebook and all that. The same like that you can go through the Colombo Stock Exchange website. It is not something else. I mean, you should not interrupt your other work with that. So that is what you have to do. Right. Now we have studied several theoretical points with regard to the stocks, with regard to the debentures or whatever, and the dividend and other cash flows. And in the case of non-dividend declarations also, how are we going to arrive at the stock price? Now this is given as the capital asset pricing model. Now this is the real capital asset pricing model. RJ is the return of the stock or whatever. Then it is equal to the risk-free rate plus RM minus RF is the market return minus the risk-free return into beta. Okay. Now we will go to this also because it also gives a certain type of now up to now we have done all these things. All these things we have discussed. Now I just want to show you some of the critical things in our portfolio return and risk type of studies. You see, now there are 5 portfolios given here and returns are given. For this portfolio, stock I has a return of 15, stock J has a return of 8%, and this is the return of the portfolio. Now you just see when the stocks has I and J weight of 50 and 50, portfolio weight is so much. Return for the stock I is 11.05 and stock J is 8. So then portfolio's risk has come to 9.53, variance 12.81. This is the SD. Now when you go through this, you will see that when two things are being taken together, the risk has come down. Right. Now, this is another indication of different portfolios. I think we have already done these things, but I just want to give a more clear representation. I mean, this representation, you find that now we talk about the stocks C and D, stock C and stock D. Stock C has a expected return of 10%. Stock D has a expected return of 30%. Sorry, stock C has a return of 10% and SD of 30%. SD is the standard deviation, that is the risk. Stock D has a return of 25%. It has a standard deviation of 60%. Now, it has a correlation of, correlation of minus 0.50, stock C and D, minus 0.50. Now what we do is, if you just get these two things, the correlation has been calculated, is this, because SD is known and we have calculated the covariance also. After calculating covariance, we can calculate the correlation. Now, if you take 5 different portfolios with different weights of C and D. Now here, portfolio number 1, it gives 100% of C. So that is, that portfolio contains only C. Therefore, its return is 10% and standard deviation is 30%. I think that is telling with the above data. If you take portfolio 2, that consists of 75% of C and 25% of D. So with that weights, you calculated expected return as 13.8 and standard deviation as 3.9. Because that is the portfolio standard deviation. Now you can see how that portfolio standard deviation has come down. Now you have standard deviations for 30% in the stock C and 60% in the stock D. But when you have a portfolio with a mix of C and D, your standard deviation drastically reduced. Now you can see with only one on one stock, there's a standard deviation of 30% in the first portfolio. But when you take the second portfolio, it has both in the mix. You have only 75% of C, but 25% of D. With that, the return has gone up and risk has come down to a greater extent. It is only 3.9%. And when you take the portfolio 3, 50% and 50% both, and 17.5 of expected return, and a risk of standard deviation of 6.8. 6.8. And when you see the portfolio number 4, that consists of 25% of C and 75% of D. And there you have a return of 21.2 and SD of 17.4. And you see the last one, it has only D. And return you get 25%, whereas standard deviation you get 60. Now that is the highest risk. And you can see portfolio number 1 and portfolio number 5 are high risk portfolios, whereas 2, 3, and 4 are lower risk, because they had the diversification effect. Now you just see the plotting of these things. Now portfolio number 1, you just look at it. Now the x-axis represents the standard deviation or the risk. Y-axis represents the return. Now you get portfolio 1. What is the risk? 30%. Here, somewhere here, 30. You see the arrow mark, no? 30. And what is the return? 10%. So this is it, 10%. So this particular point is representing the portfolio 1. If you take the second portfolio, that is represented by the point number 2. So then how can you take it? The risk is 3.9. It is somewhere here, 3.9. And what is the corresponding return? 13.8. 13.8 here, 13.8. So that is the second point. The third portfolio is represented here. And there you have standard deviation of 6.8. 6.8, see, 6.8 somewhere here. And the return is 17.5, just below 20, somewhere here. And you get the number 4. There you have a risk of 17.4, somewhere here. Return of 21. And number 5. There you have a risk of 60% and return of 25%, somewhere here. Right. Now you see the curve. Now this is a type of efficient frontier, you can see. And these are efficient portfolios really. But if you have a portfolio with some other risk and return characteristics, you will see somewhere here. And these are not efficient portfolios. But here all these are efficient portfolios if you take that way. Now, when you look at this, I think this particular point is a very important point to note. Now, when you have portfolios and when you plot all these things, you will have this type of a plot. And you have this type of a frontier. And this frontier is called minimum variance frontier. Why do we say that? Now the variance or the standard deviation, that is the square root of variance. Now when you say, if you take this point, the cross, I have put the cross here. So this is the point where you have the lowest variance. If you take any point in the curve, there the variance is higher than this variance. Now this is what you call the global minimum variance. Global minimum variance is this. And if you take this frontier, we call it the minimum variance frontier because here. But if you take now these are individual assets, not portfolios. Correlation coefficient also described here. Diversification we have already discussed. Now these are the assumptions in the capital asset pricing model. Now, there's another thing which you need to understand. Now, in the stock market, these things are very much important. Announcements and news. The expected returns are really dependent on announcements and news. Now, total return is a function of expected return and the unexpected return. Now, when this unexpected part of return is a -1, then your expected return can come down. Now, these things also we discussed, systematic and unsystematic risk. Now here the beta coefficients are given for some companies. Exxon is 0.65, AT&T is 0.9, IBM is 0.95, Walmart is 1.1, General Motors 1.15, Microsoft 1.3, Harley Davidson 1.65, America Online 2.4. Now these are the beta coefficients given on these companies. And portfolio beta can be calculated by having the weighted average betas by multiplying the beta with each weight, portfolio weight. Right. Right now, I want to just give you this brief here. Now, regarding the portfolio beta. Now, why I just come to this level again? Because we need to see the connection between the dividends, the betas, and returns, and all sort of things. That is why we again come to this and see the relevance of these things with the dividends and the betas and all sort of things. Now, portfolio beta is a particular beta value we calculated by using the portfolio weights and the respective betas. High beta security is more sensitive to market movements. If a beta security, or if a security is higher in beta, especially if it is more than 1, beta value is more than 1, that means it is very sensitive to market movements. if the beta is a low value, it is relatively insensitive to market movements. And you can just look at it, and sensitivity depends on how closely the securities return correlated with the market. How volatile the securities relative to the market. Volatility is one, the other one is the correlation with the market return. So these are the two things which we need to look at. Now, betas can differ. The reason is your frequency of getting data. It can be daily betas, weekly betas, monthly betas, quarterly or annual returns. Estimating betas over short periods, a few weeks versus long periods. Choice of the market index. So that is also another factor where the beta values go different. Some sources adjust betas for statistical and fundamental reasons. Now, just look at this. This is a very important point to note. Assume you wish to hold a portfolio consisting of asset A and a riskless asset or risk-free asset. But asset A is a risky asset given the following information. Asset A has a beta of 1.2 and an expected return of 18%. The risk-free rate is 7%. Use asset A weights of 0, 25, 50, 75 and 100. And how can we get the beta? Now you know the beta of A, and what is the beta of the riskless asset? Yes. Just to tell me, what is the riskless assets beta? Yeah. What is the beta of riskless asset? Yes, very good. 0. It is 0. Riskless assets beta is 0. So now what we are going to do? Just look at the screen. What we need to do is we need to have beta calculated. The weights are given. Weights are given. And beta can be calculated by looking at that. So just look at it and give me the beta when asset A is only 0% and it is wholly with the risk-free asset. So then what is the beta? It is 0. As you correctly mentioned, it is 0. Now there is a chart given here. Proportion invested in asset A. Asset A is 0 in that. Proportion invested in risk-free asset, that is 100. So portfolio expected return is 7. Why? Because it consists of only the risk-free asset. Risk-free assets return is 7. Portfolio beta is 0. Correct. Then you just check whether these values are correct. Right. Proportion invested in asset A is 25 here, and invested in risk-free asset is 75 here. So how can you arrive at the beta? Let me have your ways of getting this beta calculated. because you have 25% of A and 75% of risk-free asset. Risk-free assets beta is 0. So how can you get the beta of the whole portfolio? A portfolio return would be 25 into, or we can say 0.25 into 18% plus 0.75 into 7%. So that comes to 9.75, maybe, no? 0.25 into 18 plus 0.75 into 7. 9.75 comes this way. Are you okay with that? Because you have in this second portfolio, you have 25% of A and 75% of risk-free asset. Risk-free asset gives a return of 7%. Asset A gives a return of 18%. So the calculation will be 0.25 into 18 plus 0.75 into 7. That comes to 9.75. You do and just look at it and see what is whether the calculation is correct. And when you want to get when you try to get the beta can be calculated this way. Now, what is the beta of asset A? That is given as 1.2, I think. It is 1.2. It is 1.2. Then we can say 1.2 into 0.25 plus 0 into 0.75 divided by, that's all. That's the one, because we just multiplied with the weights and it comes to 0.3. So that is the portfolio beta. Then when you go to the next one, there you have 50-50 weights, and when you calculate the return, you can say 18 into 0.5 plus 7 into 0.5. That comes to 12.5. And when you calculate the beta, you can see 0.5 into 1.2. That comes to 0.6. Because others will become 0. So likewise, you can calculate respective betas and the returns. I think you now got the point. Now I will give you a separate exercise where you have to calculate. Now here given weights are 0, 100, 25, 75, 50, 50, 75, 25, 100, 0. But I will give another one. You calculate when the proportion invested in asset A is invested at 60% and risk-free asset invested in 40%. Right? You get my point. So then you have to calculate the portfolio return and the beta. Just do it. Now 60% of A, asset A, and 40% of risk-free asset. You calculate the expected return of the portfolio and the portfolio's beta. Just do it. %60 of asset A, 40% of risk-free asset. You are required to calculate the portfolio return and the portfolio beta. Yes. I think this is a simple question. You can really do it without any issue. Yes. Udeshan, Chamali, all are correct. 13.6 is the return. B, what is the beta? 0.72, yes. 0.72 is the beta. Udeshan has done it. Chamali done it. Yes. Okay. Now, just look at it. Now we can really vary the weights. And now all these portfolios are lending portfolios as it is. Now I want you to do a portfolio return calculation and a beta calculation for a leverage portfolio. So that means you invested in asset A 150%. 150%. And proportion invested in the risk-free asset would be then minus 50. So for that, so that's what we call a leverage portfolio. So for that leverage portfolio, you calculate the expected return and the beta. I will repeat. Now, a person wants to have a leverage portfolio with asset A investment with 150%. And in that case, the risk-free asset invested minus 50, that is a borrowing. So then you calculate the portfolio's expected return and the beta. I think you got my point. Now we are referring to, now all these portfolios are lending portfolios. But now we are trying to get a leverage portfolio with 150% invested in A. There you calculate the expected return and the beta. Yes, that is a simple case. Now we are now trying to have a leverage portfolio. Yes, beta is 1.8 and the return is 23.5. Correct. Correct. Now you see the return is really increased, but beta is also increasing. So that is the issue. Now you can just see, if you go for the normal lending portfolios, there you have returns only up to 18. This is the highest return. But if you do that, you get a return of 23%. So you see now, since you invested very much high percentage in the asset A, but the beta will become 1.8. Now, right now, this is a very good indication of what we have done. Now, in an expected return versus beta, graph. Now, just look at this. You see, right. Now, just look at it. Now, see, the beta is taken into the x-axis. Expected returns taken into the y-axis. And we calculated everything there. And we know what are the expected returns in relation to the betas. Now, if you go to this chart again, now beta comes to the x-axis. No, when beta is 0, expected return is 7. When beta is 0.3, expected return is 9.75. When beta is 0.6, expected return is 12.5. When beta is 0.9, expected return is 15.25. When beta is 1.2, expected return is 18. So likewise, now what you can do is you can plot it and have a graph. Now, when you do this graph, you will find that it is a straight line. It is a straight line. Now, that straight line is the indication or the representation of capital asset pricing model. And the capital asset pricing model gives a graphical presentation of the linear relationship between systematic risk and the expected return in financial markets. Because there you have taken two variables. One variable is the beta, and the other variable, the corresponding variable, is the return. So beta versus return. Beta is known as the independent variable. Expected return is known as the dependent variable. So in other words, we call the beta as the x variable, expected return as the y variable. If you plot it. Now, I think this is a practical thing where you have done. Even if you do it for a stock market asset, this relationship you can represent, or you can see it yourself by looking at it. Right. So therefore, you can see now this particular line is known as the security market line. Security market line. And it intersects the y-axis at which point? At the risk-free rate. So that is 7%. That is 7%. Now you see, now I am referring to this particular point. What is this point? If you look at the chart, that point is when the beta is 0, return is 7%. So this is the point represented here. Is the point represented here. Now, the leveraged one, I told. So there you got a beta of 1.8, is it? It is beyond this, but anyway, it can be extended to 1.8 even. And there you get a 23.5 type of return, and somewhere here. Somewhere here. So then you can maintain the straight line further. If you extrapolate this, so you will get it somewhere here. it is not this way, but you can extend this line. So everywhere you can find that. So this is what you call the SML, security market line. And on the security market line, you get a return where you have a equilibrium return. But there can be some other points where you have a return which is higher than the equilibrium return or lower than the equilibrium return. So if that is the case, you can see whether the particular stock is undervalued or overvalued. Right. Now, this is a very important point to note. And even you can do very good experiments with this. And if you calculate a particular stock's return and its beta, and if you mix it with some other asset and get a particular return, this thing, and you will be in a position to plot it and come into a conclusion that you will get a straight line. That straight line is normally known as SML, security market line. And the beta is changed, correspondingly the return also will change. But when you have a return of this nature, which lies on the SML or the security market line, we call such returns the equilibrium returns. Equilibrium returns. But if you find the return out of this line, so it can be upwards or downwards when you compare with the line. So if it is upwards, the meaning is you will get a higher return than the equilibrium return. Now, if you get a higher return than the equilibrium return, the meaning is what? The stock is an undervalued stock. Because for an undervalued stock only, you will have a return, high return, than the equilibrium return. But if you find that return below the security market line, then it's an overvalued one. That is why it can generate only a lower return than the expected return or equilibrium return. So then we call it an overvalued stock. So this is a very critical type of test we can make on a stock to see whether the stock is suitable for an investment. Now you should not, or you never go for a, you should never go for a overvalued stock as an investment. But the limitation is this: though we say it is overvalued, there can be a chance of having higher prices that we can't really predict. But if you look at the market, then you will be in a position to get some idea about the future hikes of prices. That is also to be taken into consideration. But if you feel that the particular stock may not rise in price in the near future, then it is a real overvalued stock. That all depends. Now you can see the differences of this. When the beta is 1, we get the market return. This is asset beta. So this is what you call as SML. I don't know whether you have anything as beta 1. Just look at it. Here. So it's here. So then 1 is here. So how can you check the market return? Can you get a value for market return here? Yes. Graphically, I just accept any value which is closer to the market return. What is the market return? Yes. Anyway, you can give a rough figure. How can you get the market return from this graph? Yes, I expect from you a good answer. Now, since the security market line is here, and I just want you to get the market return from the graph. You may not be possible. It may not be possible to give a very accurate answer, but you can give a rough answer by looking at the graph. Yes, try it and just reason out the things. Yes, give a rough figure. Give a rough figure for that. Udeshan has tried, but I think it is not reasonable to say 15. Just to look at it and see. I don't know whether you see it as 15, but saying 15 is not really reasonable. What is the rationale behind this? Yes, of course, Rohan's answer can be accepted because he said it is 17. I think 16 plus 16.5 or something, that is also okay. You can't say it is 15 because when the beta was 0.9, it is 15.25. So therefore, invariably, our market return has to be higher than that because market return is the return when the beta is 1. Rohan's answer can be accepted, but there can be even 16.5 also we can accept because we can't just look at it and see, this is not a real graph. If you do a graph on the graph papers and just get it, and that is the most correct answer. But I think as a rough answer, 17 can be accepted. Now, you know what is the rationale behind this, no? Yes. Someone has said 16.16. That is also, I think that is a more correct answer, I think. Yes. Udeshan's answer, yes. Right. I think now you got my point. The point is that through the security market line, you will be in a position to get the market return by going through the position where the beta is 1. When beta is 1, you have to check what is the value of expected return. So that value is the market return. Now, if you go to the graph, there you see, now when beta is 1, this is the 1. You can look at the arrow mark here, and you just have a line, perpendicular line, which meets the graph at this point. Say this is the point, and you mark it and have another line parallel to the x-axis, and it meets y-axis somewhere here. 16.16 is a possible answer, right? Okay, I think that's good. Now you can see how you can graphically arrive at the market return through the SML or security market line. Right now, this is a question. Asset A has an expected return of 12% and a beta of 1.4. Asset B has an expected return of 8% and a beta of 8.8. Are these assets valued correctly relative to each other if the risk-free rate is 5%? Now, these are the things which we have already done. Right. Anyway, I think today we are not in a position to go further. But if you, if you have any issues or any problems, you can have another couple of minutes. Yes. Now, I think you can try those things in the website, and don't take it so serious, but you can, in your leisure time or in your, as a hobby, you can do that. So that is what I expect. And with that, if you don't have any other clarifications also, I can wind up. Right. Now with that, I just wind up the session today, and you can just go through the Columbus Stock Exchange website and do the needful. And as I have given you the company names, and they are betas, and they are past dividend declarations and PE ratios. This doesn't take much time. It's a matter of just accessing the website. Don't take it so serious, and you don't need to assign more time. Longer time for that. It's a matter of just looking at the website. So therefore, there's no any calculations involved and all that. So you are in a position to do that without any trouble. Even you don't need even 2 weeks for that. Right. So with that, I just wind up, and all of you should actively participate in the learning process. And I think you all will get a very good chance of having insight into this subject and you will be in the position to make use of these things in your decision making processes. Right. Thank you all of you for your active participation and your comments and all that. And if you find anything wrong or whatever, you can point it out, because sometimes I purposely put the things wrong sometimes. So in order to get your attention for that. And I think that, of course, you have to be vigilantly look at those things. Okay. Right. With that, I just wind up the sessions, and thank you very much, all of you.